Hello, everyone. As many of you know, my name is Alexa, Operations Manager here at the BPM RIA office. We have an awesome webinar today. You guys are in the right place. This is the Broward Palm Beach, Miami Real Estate Investors Association, your only local chapter here in South Florida that's partnered with the National Real Estate Investors Association. We're going to get into this awesome webinar today. Benefit of investing in hedge fund during high inflation and economic downturn. We have our founders here today, Anish, Taryn, and Jason, and they're going to get into it. But before that, I'm going to give you guys some quick announcements. We are locked and loaded for this month. A bunch of webinars coming your way. Free webinar next week. We have a free in-person workshop on Saturday next week. Really looking forward to meeting even more of you guys that are over in Miami-Dade County. This will take place at the Hyatt Place, Miami Airport, West Doral. It'll be a nice 2-hour workshop. Really, really excited about that because I get to meet more of you. So after that, following that workshop, we'll have Jose Ramirez back for a tax planning strategy webinar, which I am already having so many people ask me, when is he coming back? Here he is. So don't miss out on Jose. He always has so much information to share with you guys. And I just have to take a moment to highlight this webinar right here. Last day of the month, ending off strong. We're going to have Sharif Medawar talk about the ultimate asset protection. It's going to be a workshop, free webinar. Sharif is one of Anish's mentors, and I learned so much from him. So you are not going to want to miss this. And I have a couple sneak peeks to share with you guys so you can get prepared for this one right here, because it's going to be a big one. And then, as you all know, we always have our monthly meeting, first Wednesday of the month. This one will be online. It'll be a free webinar. We're having Get Fundable come in. We typically have one of the co-owners, Meryl Chandler, but this time we are having the other co-founder come in. I'm excited for you guys to meet him, and I will be introducing you to him very, very soon. So go ahead and register for our monthly meeting, how to recession-proof your business fundability. And of course, you can find all of these events on our website, throwing the link in the chat for you guys right now. You will notice that I'm putting a lot of helpful links in the chat for you guys. My favorite way to keep up with our events, as you guys probably know, I always talk about it, is the text message updates. Whoever's opted in for this, you all got a text message this morning reminding you of our webinar today. And I just think this is so helpful. You can register straight from the text, either take a picture of this or go ahead and look in the chat. I threw this in the chat for you guys. You're going to want to text BPM REIA, all one word, no spaces, to our event line, 954-800-6961. This is not a calling line, guys. So please just go ahead and text to opt in, or we also use this number for raffles. So you guys will not get to me if you call this number. You all have my information by the end of this webinar, so you can contact me directly. All right, Quick Start Boot Camp, guys. Our next Quick Start is January 21st and 22nd. This is a 2-day, all-day training online on Zoom. The entire training is led by Anish, our CEO and lead mentor. You're not going to want to miss it because we are going in on this workshop. We have 4 guest speakers. We get into wholesaling, rehabbing, flipping. It's 2 full days. As you can imagine, you're going to learn a ton. These are just a few of the topics that we covered during this workshop. I went through the link in the chat for you guys so you can see all the details for the guest speakers we have on, all the topics we get into, dates, time, everything. You will have a detailed itinerary if you sign up for this workshop, as well as a booklet to keep for life. It is a money back guarantee. So anyone who is wanting to grow their strategies, this is a perfect training for realtors that are trying to learn some non-traditional strategies. anyone who's interested in having a mentor, very, very much so recommend this training for you so you can really see what we're doing, how we do it, why we do it. This is going to be a really, really good place for you to get some more intimate time with us. And it's really awesome. I've been to all boot camps, so I can tell you. And yes, of course, we have member and non-member pricing down below. So please, please let me know if you have any questions. And thank you guys so much for responding to the poll. I appreciate that. So memberships at BPM RIA, since we are in compliance and partnered with the National RIA, we get a ton of great stuff from them, especially from Home Depot, Office Depot Business, Rent Perfect, Avis Budget, just a ton of great vendors that we get through the National RIA, just a ton of discounts from those. You're going to get into our in-person networking meetings for free. Your guests are going to get in at half off. You're going to get a discount for all of our workshops and special seminars that we have. So I highly recommend you get the membership if you are going to be involved in the RIA, so you can save a bunch of money. Pretty much your savings will pay for your membership. So let me know if you have any questions about that, but thank you guys so much for responding to the polls. I will be looking out for you guys to purchase the membership. And of course, once you purchase the membership, you will get a welcome email from me detailing all the things that you can do with your membership so you can maximize your membership with us. And of course, we have the corporate membership opportunities. I would love for you to give me a call if you have questions about these. Awesome. Awesome, awesome. All right. Last but not least, we do offer one-on-one coaching and mentoring at BPM RIA. It is a truly one-on-one coaching program. You are matched with a mentor. We do put up 100% of the money for our students' deals and split the profit 50-50. This is very unheard of around here. So of course, we do take limited students, want to make sure we are in alignment. So if you have any questions, please, please don't hesitate to schedule a discovery call right now on our website. So you could have a chat with me and I can get you our brochure in your hands so you can see all the things that are included in the mentoring program. I can also help with scheduling a 1-hour free consultation with a mentor. So this is a great, great way to just go ahead and book a time that works for both of us. Yes, this is my direct line here, but easiest way is to go to the website and book that discovery call so we can have a chat and I can get you more information. And thank you guys so much for responding to the polls. I appreciate that. Always want to take a moment to thank our sponsors, thank National RIA, all of our vendor partners, thank Anish, Taryn, Jason, everyone in this webinar right now. We wouldn't be able to have these great webinars if it wasn't for you guys. So I just want to always make sure we are thanking you guys because that's what makes us awesome when we come together and ask a bunch of questions and learn. So let's do this thing.
Absolutely. Thank you so much, Alexa. So I do see some new names on there on this webinar. So my name is Anish, president of BPM RIA. So for you old timers for 2 years, you're probably sick of seeing my face, all the thousands of webinars that we're doing, and we're doing them for you actually. So it's my job as the owner is to really bring you great speakers, education, as we work through this crazy world of what's happening out there. So today I have some awesome speakers, which includes me, I guess. No, I'm kidding. Obviously my partners, Taryn and Jason Davis, and I'll let them give a little quick intro about them. But how many of you guys, and you can put it in the chat, have heard of the I word, meaning inflation, the enemy, right? Like that's our true villain on that portion. And what the heck do we do, right? Like, what am I going to do with my money? I'm making some money and, I don't want to put it in the bank account because it gets me actually now instead of 0.001%, they're probably getting maybe 1 or 2%, right? On that portion or, if you're like me, again, me, I'm very transparent. I am in the stock market and let me tell you, I want to throw up. So I don't want to look at my portfolio. I don't know why I still put stuff in that I have no control of and all that other good stuff too. And I have some, risky stuff in my stock portfolio. And then I have some good old, good old companies like Apple and Microsoft, and they're still down. So I don't know what the heck I'm doing when it comes to that. So I hate to say it, I almost don't want to look at my quarterly statements from the market because it's always so challenging in general. So today, one of the things that you may or may not know is that I'm very passionate about real estate and bigger projects. And one of the things that I want to say, it's about a year. I don't know, all the time always seems the same now, but probably about a year and a half ago, I was very fortunate to work with Jason and, Taryn. I've known Jason for, I don't know, like, I think we're on like 15, 20 years.
20 years now.
20, yeah, somewhere around there,
You're
right?
like my second wife.
Yeah. Yeah, and Taryn's my work wife too. So obviously she's a lead mentor on that portion. But what we came together as a group, and we wanted to use our resources. So we did create a fund, and it's called DPI for short. So you'll hear us say DPI, but it really stands for Diversified Passive Income Fund. And I'll give the floor to Taryn and Jason a little bit to introduce themselves on.
So I'm Jason Davis. Hello, everybody. I've been in the real estate industry for quite a long time. I would say at least over 15 years. Have a long-lasting relationship with my second wife, Anish. And we wanted to create something that was simple and something that's very important to everyone, which is cash flow. And we can all say cash flow is one of the most important things to us. So we're going to go into it. And Taryn's going to introduce herself as well. And we'll begin.
Hi, everybody. Good morning. It's good to be with you all. Excited to have you. I met Anish and Jason. Well, I met Jason a couple years ago, but I've known Anish for quite a while. And I just got relegated to his third wife. I'm not too sure how that just happened. Jason's just moved in. But I've been in and around real estate. I'm well known for wanting to be in kind of every space. So, I've got rehabs going. I do a lot of wholesaling. At the moment, I'm doing a little bit of lending. And what I'm really passionate about is helping women in this space to be able to grow and have success inside of real estate. A few years ago, I created Woman Wholesaling Houses with a friend of mine. It's a Facebook group, and we have over 26,000 women nationwide that do different aspects of real estate. And I'm really excited because next year we're going to open up a chapter for the BPM RIA for women. And, with all of that, DPI was a passion project for Anish, Jason, and myself, because it really allows us to be able to do bigger projects and be able to impact other areas by being able to raise money, and we're able to help people get a secured return. So I'm excited to get into it today. I'm going to turn it back over to Anish.
Yeah, so now the team in general, as Taryn said, is for us. It's been a passion, and we're constantly growing too. So you'll see on November 30th when we have Sharif Medawar speak, he's actually started his own fund, and we're a fund of funds, and he's actually one of my mentors too. So you're definitely not going to want to miss that too. So and throughout if you guys are new, just in general, I know a lot of you guys have been on webinars. Just put your questions in the Q&A. We'll try to get to them. We'll also throw some polls up there just to get an idea of who's listening in too. So, so what's the benefit of investing in a hedge fund during inflation? What do you guys think, is the question, right? So why invest in funds? And remember,
so this is throw what you think in the chat, guys. So why would you be interested in investing in a fund? What do you think the benefits are?
Right. And so do you guys, I mean, let's not just assume everyone knows what's a fund, right? So Taryn, do you want to kind of talk about what is an actual fund and how does it work, I guess, the basics?
Yeah. So, there are different types of funds, right? And we're going to go through those in a second. But a fund is basically where you're collecting or raising capital to invest in different projects in different areas. So you can have real estate funds, you can have mutual fund funds, right? Like that's kind of what most people think of when they think of funds. And it's just where you pool money into a certain area. I think, Anish, you're invested in a marijuana fund, aren't you?
I am, unfortunately. I might need some product to make to help offset my losses right now.
Definitely. So one of the most important things I see, David's mentioned, like, he thought that funds were for people with a lot of money. And that's one of the biggest myths that people have. It's like rich people invest in funds. And it's really not that. There are entry level ways to get into funds. But the most important reason why we invest in funds is because it's not an active investing. It's more passive, right? For Anish, myself, and Jason, we're actively because we're managing the fund. But for somebody that has capital and, maybe they're busy and they don't know what to do with it, or they're not, like Anish, not happy with the stock market and things like that, you can invest your money in a fund and receive either a return, like a fixed rate. You could receive an equity share. There's different profit points that you can get, but it's really you're investing and you're forgetting about it. And it's going to make the money passively for you. And so most people, when they get into real estate, they love passive investments, right? Because who really has time to dive in and go through each of these your investments all the time when you've got a full-time job? Maybe you're a professional. We have some people that are in the medical field, right? So they've been super busy the last couple of years. They've been making a lot of money, but they don't have time to say, oh, you know what, I'm going to go research this project and this is what I'm going to go invest in. So funds are really great for that kind of investor to be able to passively have their money work for them and grow.
Yeah. And just out of curiosity, got to put in the chat. Remember, guys, this is interactive. So how many people want passive income? Right. So even for me, one of the big issues I'm having right now is that I'm making great income, but unfortunately, if I had to really look at my portfolio, I'd say 80% is active income. I have to wake up and do something to make money versus, on the passive side, it just comes to me. Right. And there's different ways of, get passive income. Right. You always hear it if you own properties. That's a way to get passive income if you're not managing it. So I do have friends that have said, oh yeah, I own properties, it's passive income. But I'm like, didn't you go there yesterday because there was a problem? Oh yeah, I did. Or I had to go collect rent. And I'm like, yeah, that's not, your definition of passive and my definition of passive is very different, right? So I kind of call it like mailbox money. I do own some properties as investment. And, what I like about, the fund or different investments is that I want to diversify. And that's something that's really different. I don't want my, all my money in one asset class or one piece, because I did that in 2008. And I don't want to tell you what the story is. If you've been watching the webinars, you know what the story is. Like, had a bunch of stuff and then I didn't too. So as we kind of go around, it gives us a good idea. I'm going to throw up a quick poll where I just want to know what percentage of your investment is in real estate. I'm just kind of curious if you had to look at your portfolio in general, and if you're new, that's okay too, right?
We all started somewhere, that's for sure.
Absolutely. Yeah. So Eldon, I see you want some passive income on that. I see Raphael. Absolutely.
Yeah, who wouldn't want passive income? I mean, like, my Netflix game would be on point if I could just like have passive income.
No, I was just talking to a guy yesterday. He was telling me about his multifamily rental, and he had some electrical issues going on, and he was telling me how much money he has to come out of pocket, and he has to go over there and hire get the handyman or the electrician to go there. I mean, it's work, and owning real estate is another job.
Yeah, it can be a job, right? So I'm going to start with, just so you guys know, obviously we're active real estate investors. So we're not saying don't invest in real estate. I invest in real estate. It's my money maker. It's just that I'm just trying to alternate, where I get monthly money and I don't have to open up my portfolio and see that, hey, the Fed did this, right? The politics of this, whatever happened, yesterday, and so. And, unfortunately what's happening in Ukraine and, the gas prices and like, it's overwhelming sometimes. I'd rather just watch some Netflix and shut off my mind a little bit when it comes to that versus my actual portfolio.
Absolutely. I totally agree. I think most of us can agree on that.
Especially at the moment.
I know.
Yeah. So, I mean, there's different, so that's an idea of what a general fund is, right? And I do see actually, what's funny is I'm looking at here, more than 50% of you guys are in some sort of real estate portfolio or in real estate. While we kind of talk about the different types of funds, put in the chat, like, how's it going being a landlord? I'm going to assume you're a landlord of some sort. Do you like it? You love it? I'll never do it. We even even some of the other mentors, they love fixing houses. Then they hate fixing houses when they do it. Some people love being a landlord and they got doors. And we're going to kind of talk about that in a bit too. So what about the landlord and what you think your money is really doing too with that bad word, that bad I-letter word, inflation, and what it's really doing to your money too. So.
Yeah, so let's talk about the types of funds that you can get and, what the good, bad, and the ugly are. So how many of you, drop in the chat, know what a syndication is or have heard about it?
Isn't that the reruns of Seinfeld? Isn't that?
Only for you, Anish. So a syndication is can be put together a couple of different ways, right? So generally speaking, when you're syndicating in real estate, you like if I was going to raise money for a syndication, I would have one property. And I'm going to say, hey, listen, I've got this, multifamily deal I'm taking down. I'm prepared to give you an equity portion of it and maybe a preferred return. So what that means is, you give an $100,000 in the syndication, you might make, a 6% or an 8% preferred return, which on the cash flow, once it starts cash flowing. And when I sell it, you're going to get a piece of the equity on the back end. Right. And so people really like syndications because typically speaking, the returns are a lot better. You're investing in real estate. So you get to be like, you can say like, I own 100 unit without actually having to do all of the work with it. Well, some of the challenges we find with syndications is, first of all, it has a lot of times they buy value add properties. So there's no income in the beginning. Right. The second thing is that generally speaking, you're holding that property for 5 years or longer. So your money is locked into the investment for that period of time. And it's almost, I'm not going to say it's impossible, but it is very challenging to get money out of the deal at that point if you have a life event, right? And then the other thing is that you really have to trust the person that's acquiring the property and managing the property, that they know what they're doing and that they're pro forma. So what they're expecting to happen is legit. So you need to find somebody that has a proven track record, right? So those are some of the challenges that I see inside of syndications. I don't know about Jason and Ish, what do you guys like and love about syndication?
I think you're 100% right. It's long-term investing. Your money, it's you don't have that, you can't access that money right away if you need it for cash flow or for other investments. So they're good. They're good for long term, but there are disadvantages, for if you need cash at the moment.
Yeah, I mean, I like syndications if it's with the right person. And that's the loaded question. What Taryn's kind of talking about is, how do you know or trust the board members or whoever's starting that syndication, right? Can I call them up and say, hey, I got this? I do like it in the matter that, hey, I could invest in real estate without actually being active. So I'm still in the real estate world, taking advantage of it. What I don't like about some of the syndications is, Taryn was talking about pro forma. So that's what they expect the rents to be or the values to be. And a lot of times, gosh, I don't want to say it this way, but what I've seen, I'll start with that way, is that, oh, the repairs will be X amount. You're going to put this amount of money in, there's 50 other people on this project at 100,000. So let's just say it's $5 million. Oh, we miscalculated about the roof on the building. So now we have to do another capital raise. Hey, Anish, remember that you put that $100,000? Guess what we need? I need another 20,000. What? On that end of it. And the reason I'm saying that is I've been in a situation where I did get a capital raise call, right? So it's not fun. It's challenge number one. Number two is you're guessing what's going to happen to the market, right? So think of pre-pandemic. When the pandemic happened, March 2020, the world literally stopped, right? Everyone's freaking out, including me. Like, oh my God, what am I going to do? Is, no one's renting, no one's buying. And so things can happen that you don't have control. So if you don't have multiple exit strategies, or you're not in a syndication where, they're experienced enough, is number one. The other challenge is that I've seen syndications where they're newer syndications and the principals have no money in the deal, right? So I'm a little suspect on that. Yeah, if you've done 20, 30 and you have a massive proven record, yeah, then I'm okay with it. But hey, I'm just going to start it out and syndication, we're going to get a bunch of people together and do this. And besides on this, there's the right way and the wrong way to do syndication. So a lot of times there'll be, oh yeah, we'll get 5 friends and do this and we're doing a syndication. And it actually violates, pretty much every law out there. So you want to make sure the capital structure is correct. And the funny part was, the reason we actually did a fund was because I always wanted to do syndications. I've sold multifamily, I love it. And that's when Sharif Medawar goes, well, great. If I find a great deal for 5 million, how fast can you raise $5 million? And I'm not looking to have 100 partners. I'm trying to make it, easy for myself, with, obviously limited partners. So that was partial reason why we came up with the fund.
Yeah, and I would say that's definitely, as far as which fund if you're going to manage a fund, right, and create your own fund, that was definitely a consideration for us because if you find a great deal, now you're under a timeline to raise the money, and if you have the money and then you find the great deal, typically people have already invested in something else, because at the end of the day, today's talking about inflation and an economic downturn. The biggest killer of your money is letting it sit there, right? And so anytime you've got cash, you want to be investing it and moving it. That velocity of money is really where wealth is created.
Yeah, and just so you guys know, I know there's some newbies on here, and you're saying, wow, that's a problem. It's going to sound funny. When I didn't have anything, money wasn't a problem because I didn't have any. Right. So as you start getting better and you start, building your financial future, it's going to sound crazy. But now when you have money sitting on the sidelines, it's a big problem. It's going to drive you nuts. And what happens, and again, I'm going to speak from experience, is you start making, not you, but I'll say me, right? I started making bad decisions because I just wanted to deploy money. And I was like, oh yeah, the returns may be this. On that end of it, I'm chasing is probably the
so what is the worst decision you can make in that situation? And I would say the worst situation is to do nothing. And so we see this time and time again where people have access to cash and they're sitting on it because they're too scared to make a decision of where to go. So it's the one side of it, having the knowledge to be able to make smart decisions and understanding the game. But the worst thing that you can do, in my opinion anyway, is to do nothing, because with the inflation rising, I mean, what are we at right now with inflation? 8% or something silly?
Yeah, it's actually a little bit higher depending on.
Yeah, I mean, with inflation,
it's about 9 and change right now.
Yeah, if you've got money sitting in a bank account, it's losing money. If you've got money sitting in a self-directed IRA and you haven't deployed it, it's losing money, right? So let's talk about REITs. You want to hit us off with that, Jason?
So basically, I just want to say everything that we're talking about here, all these investment vehicles, we actually took each benefit from each investment, syndications, REITs, crowdfunding, and debt shares, and that's how we came up with DPI. We wanted something very simple for investing, not something complex, because each investment vehicle that you see here can't get really complicated. There's a lot of ins and outs of each investment vehicle. So that's why when Anish and we got inspired, we want something that has all the benefits, all the bells and whistles, but something that was more simple to invest in with no headaches. So as we go through these, like REITs in general, REITs are very similar, like they all have a lot of similarities to each other. So REITs, you can invest in a REIT, and every REIT is like a trust per se on the property itself. So you can invest in a warehouse REIT, you can invest into a development REIT. It could be a REIT, could be anything pretty much. But a REITs, you can find them on the stock market, and they're very volatile. They go up and down. It's very hard to project, what your returns are going to be. And that's why, we were so passionate after going through all these investment vehicles to come up with something really simple and less complex. But REITs can get very complicated, as similar to syndications as well.
Yeah, I mean, the big thing with the REITs also is that, like, let's just say, it's a commercial REIT, strip mall, whatever it is on that event. What am I going to do to make it increase? What am I going to go buy a strip mall? Like my control issues are really get pushed on it. I kind of joke about it, like I have Apple stock, right? What am I going to buy? 100,000, iPhones to raise the stock price on that portion. So it is a passive way that you kind of forget about it. And it's the same thing that you're really, looking at. Not, I know you can't go by historical records of the REIT, but it's the same thing out there, but you are in real estate too. So.
Yeah, and just so for those people on the call that don't actually know what a REIT is, it's in a real estate investment trust. They do give dividends. One of the downsides with a REIT is that it's low growth, right? 90% of the income goes back to the investors. So only 10% is able to go back into grow the asset and grow the trust itself. And, it's subject to market risk because it is, it can be traded online publicly. I do know of somebody that as we were hitting COVID, COVID was a big eye opener to a lot of people, because when they shut down the country, everybody got a little bit nervous and they wanted their cash back in their hands, right? Like the last thing you want to do is be invested in something and, the economy's taking a downturn. So a lot of people were going to these funds and requesting their money back out, right? So one of them, I think it was Peer Street. I forget exactly which one. They had like massive prepayment penalties. And some of them were like, no, you can't take, because it was almost like a run on people trying to pull their money out. So you can imagine if you're a syndication, for instance, and you own a multifamily and you have 10 investors and 3 of them say, I need my money back out right now. And I don't care, I need my money out. You're going to have to sell the asset, right? So with the REITs, what they do, in this particular REIT that my friend was investing in, their returns were, 10 or 11% at that time, which was really high. They actually dropped the return so that when they pulled their money out, it was a lot less. It was down in the 4 and 5, and they manipulated it that way on purpose so that people wouldn't take their money out. Which was like a big eye opener to me, because I had always thought about REITs and it's very a passive way of investing. There's a lot of transparency with it, and there's stable cash, right? Oh, we lost your slide. There you go.
REITs are like stock market. It's the same type of behavior. They go up and down. You have to keep your eyes on them. You don't know that they're not really fixed. You're not really getting a fix.
Yeah.
And my favorite, crowdfunding, right? I mean, what's funny? I think crowdfunding's been only around, gosh, it's relatively new. I mean, it's only been a few years. I know it's less than 10 years minimum on that portion, where, you get a bunch of people, I've seen some crowdfunding as little as like $50. You could put different things in it. Obviously Jeff Bezos has got one right now on real estate. So it's a way to, if you have very small amounts of money, to be part of a group, same kind of things as a REIT to an extent, but it just depends on the project.
And crowdfunding could be any platform. It doesn't have to be real estate. So crowdfunding could be, anybody can do a startup for crowdfunding to raise capital. But crowdfunding is usually it's nothing concrete. They're raising the money to actually buy an acquisition, or they're raising the money for a possibility, or you're actually you could be investing money into one platform, like it could be maybe a development or a building. But crowdfunding, you can get it, they'll start you on a free account, but there's a lot of fees when it comes to crowdfunding.
Yeah.
They don't show you in the beginning.
It's
Yeah,
the same. Oh, I'm sorry. Go
Yeah, I
ahead.
was just gonna say, and the reason for the majority of the fees, right? Whenever you have a fund that has a lot of people investing in it, you now have management fees, you have accounting that has to be done, and so those fees really, really climb up, and the fund's not taking care of it. They pass that on towards their investors, and a lot of people. I've seen people in the stock market and they're like, oh, my returns are 20%. And I was like, oh, okay. What are your fees? And they couldn't answer me. If you look at what your financial planner is charging and stuff like that, fees are a big thing that will eat up your money faster than anything else without you even realizing it. And so crowdfunding, I think that's like the biggest turnoff for me is how high their fees are. And it's like, you don't even know that you don't know it, right? Like it's something that'll hit you when you're trying to take your, money out or as you're trying to grow it. It really hits the growth of what your money can do for you.
Yeah, I totally agree with that. And that's, a lot of times it's called loading fees. You'll see them on mutual funds and, everyone needs to get paid. So I think that's always important. And again, we're not knocking any of these other types of funds. It's just that you have to know what's happening in them.
Right.
Versus blindly not knowing the fees and exactly what Taryn and Jason are talking about, they kind of just stick them in. It's not like a line item on a real estate transaction per se. It's that super tiny print on that end of it. So that's how it comes out.
If you go on social media, especially Instagram and Facebook, there's a lot of advertising for crowdfunding. But if you decide that is that something that you want to get into, you got to do a lot of due diligence. You really got to understand what you're getting involved in, because it's like investing into a stock. You have to know a lot of you can't speculate in something like this. It's your money.
Yeah, and I would say the other thing is like one of the things we didn't talk about with funds is that all funds are regulated by the SEC, the Security Exchange Commission, right? If they're not, then they're violating it. That's not where you want to be putting your money. Right? And so it's very important to take a look at what they're offering, because everything has to be spelt out there. And again, like Anish said, there are great syndications out there. There are great REITs. There are great crowdfunding. Absolutely. This is all about telling you the pros and cons and what to look out for. You can definitely find a crowdfunding that has, maybe not such high fees, right? Or it's a limited type of thing and they have it where you can invest a small amount smoothly. Absolutely. We're just kind of why we chose, and we're going to go into a debt share fund and what it is and why we like it. Well, let's do that now. Yeah. So a debt share fund, is basically where you are getting a fixed rate return. So almost you're the lender in the fund, right? And it's the reason why we like it is because you don't have, it's a lot less riskier for our investors because they're not in an equity position. So when we capital stack, right? If let's say we had a single family house, for instance, and it was worth $100,000, right? And we got a mortgage on it for 70%, and the 30% was our equity, right? It was coming out of my pocket. Well, if the market turns down, the equity is the first thing to go. It's the first thing that gets eaten up. The debt gets paid no matter what, right? And if it doesn't, then we got like serious issues. So one of the reasons that I like debt shares fund is it's predictable. You're in a less risky position inside of the capital stack, and you can kind of count on what you're getting back.
Yeah, that's a good way to talk about it. And on top of it, and even in our fund, it's not just one house, right?
For
so
sure.
You're just basically leveraging risk. We're talking, and again, it's not that I don't mind risk. I don't want risk on everything. And that was the problem I had in 2008. Was I didn't think there was any risk, and I was like, yeah, everything's good. And I realized everything was not good on that portion. So now I'm this time around, I got some risky things that I kind of call my play money. If it does okay, if it doesn't, that's okay too. Versus I still want to have a foundation of what I'm making too. So I'm going to throw a quick poll on here because we're talking about different things. And I just want to know, as an investor, what's the most important thing to you guys? So go ahead and put it, on the poll. And so let's talk about, obviously the benefits. And I know Taryn kind of hit on some of those on the debt fund, right? It lowers your risk, especially if there's actually a portfolio out there, more than one house, one building, right? Like a syndication. So it leverages that end of it. Steady income, right? Like for me, like it's nice to know, especially you guys, some of you guys are landlords. Maybe some of you guys have Section 8. When I rented out to Section 8, it was great to see every month, like getting that ACH deposit right into my business account. I was like, okay, it's the first of the month. It's pretty much guaranteed money. What I can't say, obviously, with any fund, right, it cannot be guaranteed on that end. There's always risk involved in general. But I see, like, I'm looking at this poll here. I could see like liquidity is a big thing for you guys.
Liquidity is a big one here.
Yeah. Most of you guys are worried about liquidity.
Yeah, and that's the best part. My personal feeling about a debt share fund is that when, like I was telling you about COVID and how we had a lot of people in different funds and we were getting all these stories back. Inside of a debt share fund, they can get that money out straight away because they're pulling from the reserves. Very rarely do they actually have to go sell the asset, right? Obviously, if you've got 10 million in it and it's a $20 million fund, they would probably have to. But for the most part, like for instance, like DPI is $100 million worth of assets that you're backing on. So if you need to get your money back out, you can get it back out. We don't have to go sell a property. We don't have to, fire sale or rehab or anything like that. And you don't have to have your money in for the entire length of a project. So we could actually take one of the projects that we were working on a few years ago was a development. We were building an assisted living facility. I think it was in Michigan. And that there would have taken 5 to 10 years to, build, develop, stabilize, and so forth. And as it is, we ended up leasing the land back, right, to the developer, and we got out of that deal. But the point is that can you imagine you're putting your $100,000, your $500,000, and you're going to get your returns, but you're like biannually, but you can't get that money back out for 5 to 10 years. Well, you don't know what's going to happen in 5 to 10 years. Who knew that COVID was going to happen? Maybe you have some sort of health concern that you need to get the money back out, or maybe you're in a downturn economic environment where you want to be able to get your money out to be able to go into another opportunity that might pay you more. That's the benefit of a debt share fund. In that shorter period of time, it's not locked into things, but it is backed against an entire portfolio of real estate. And that's where the lower risk comes in, right?
It's a safer, low risk, recession-proof investment vehicle. And that's why we took all the benefits from the other platforms and we came up with something simple, not complicated, and 12 months of liquidity. That's it. So in 12 months, you have your money working for you passively, earning interest. You have a fixed rate. It's saved backed on diversified commercial properties, guaranteed leases that are payments nonstop. This company's been around for over almost 20 years. Great history. So that's why we were so excited for this and bringing this out to the public. And we've been working with a lot of our clients right now and benefiting from this investment. We've been benefiting from this investment. It's been great. It's been great.
Yeah. So, I got a question for you guys that are in, especially the people about interest rate. Some of you guys said interest rate is really important. I'm just curious, what do you guys think is a fair interest rate on a return? Right. And I say, don't give me some 40%, loan shark. I know some of you guys, I see you at the meetings. I know you a bunch of loan sharks. That's not realistic. You're not part of the Gambino family here. So what interest rate would be fair that you'd be happy with? So I'm kind of curious.
That's a great question.
On an investment, right? Because it's always I'm always curious because what I might think is fair, you might say, nah, not so much. And the way I'm using that also is because because what's your alternative? Like, meaning, yeah, I want 15%. Well, where are you really? Are you in, crypto, right? I'm not even going to talk about what's happening right now with that mess right now, but just kind of curious on that number, what you think is fair.
Yeah, it's interesting, like I mentor people in real estate and stuff like that, and they always want me to give them a definitive answer. Like what interest, and it's not really the interest rate, because it's really what your return is, right? Just because you're getting a 10% interest rate, right? That doesn't mean that's what your return is. And so I think that it's very important to kind of differentiate that. But it's very interesting. People want to be like, well, I've got this project and, my cash on cash is X. Is that good? I don't know. Is that good for you? Because, one person might be 70 years old and they're looking, they don't need to have a higher risk and higher interest rates or a higher return. And somebody that's, just coming out of college at 21 might be like, look, I don't care if I have money, when I'm 22, but I'm going to throw it into crypto like so many of them did. And next thing you knew, they were millionaires because they took on this highly risky investment. So I see that John said 6.5 to 10%. That's a big spread, John.
I want anywhere from 2 to 12%. No, I'm kidding. We're just busting your chops, John. Thanks for at least, putting in it. What about the rest of you guys? You guys don't care if you get any interest? Interest rates not important. Like, what would you look at it on any kind of prospectus, right? Is your money in a CD, certificate of deposit, right? And it's important what Taryn's saying is that it depends where you are in your life and what else you're invested to, right?
So Rosemary said a 10% cap, right? So that's not your interest rate. That's, like that's a return on your capital investment, right? So, okay, gotcha.
Yeah, not bad. So here's one of the challenges that,
Eldon said CD, do they even have those still? Yes, they do, Eldon, and people still invest in them.
yeah. So even like the 10%, I could tell you right now, the probability of you buying something in South Florida and getting a 10% cap rate is probably not good unless you're using advanced strategies of short-term rentals and all the other things that you may or may not be doing. And I'm not sure if that's going to be passive, right? Maybe you already have it. I know for some of the people that I know through our network, it is passive for them, but they've actually built out a business on that portion. But usually the mom and pop 1-2 properties, it's usually not passive on that portion. But yeah, the 10%, and there's a good chance for Rosemary, if you're investing, you might be in the Midwest where cash flow is great, appreciation not so great. So that's
and I would say that from what I've seen across the nation right now, there's unless you're in a war area or an opportunity zone, for the most part, you're not seeing that kind of return on any kind of even syndication or anything right now. I know in South Florida, people are picking up properties for syndication and so forth at 4 and 5% cap rates right now. Now, obviously, that's not their returns. I could get really involved with internal rate of returns and stuff like that, but I'll keep it simple.
Yeah, don't nerd out.
And assisted living facility is more than a 10% cap. Yes, it's a lot more complex than that. I've actually got somebody that's trying to buy an assisted living facility right now. The returns are great, but he can't get leverage on the property at all.
Yeah, and that's what Jason's background is. He's actually been part owner of assisted living facilities too. So just out of curiosity for you, because since you're a part owner, I know it's a little off subject, but how passive was it for you?
Oh,
you gotta mute yourself, Jason. You got to mute yourself. Yep. Oh, you remuted yourself. There you go.
It wasn't passive at all. It was tremendous amount of work. I think I actually sold the assisted living facility, and I think the best moment was when I started it the first day and when I sold it the last day. It's a great source of income. Don't get me wrong. They, depending if you know what you're doing and you're willing to put in the effort, it's a great business. But it's definitely not passive. You're working for it.
Yeah, and again, like until you start building a few out and you build a business, it's the same thing, right? Like as I said, like we have friends in our network, they own 20, 40 doors, but they're managing it themselves, right? And it keeps them busy, and they're the first people to complain about it too, which cracks me up too, is that, oh, I can't believe this, and they don't want to pay the fees. And the problem with any of these things that, Taryn's talking about leverage, whether it's leverage of money, right? Like financing is number one, and leverage of people, right? So if you want to build anything, you can't do it all by yourself. You need a team in general. So again, we're not saying these are bad asset classes, bad businesses. We do, individually, we have other businesses, but it's part of me, I'm like, yeah, I like the passive end of it. And as I mentioned, that right now, predominantly all my income is active, right? I have to wake up and do something to generate income, and I'm trying to get it to more passive, or at least to 50-50 is really where I want to get to. And one of the things with our fund is we're talking about lower fees. You heard fees. We have 0 fees. Is that fair, guys? I mean, unless you guys want to pay a fee. We actually created this fund since we are partners with Sharif Medawar with the fund of funds. He's actually taking care of the back end stuff for us. So we are passing our no fees. You heard Darren talk about, hey, we're going to pass the fees on to your investors. Well, we're passing our no fees on to our investors. Is that fair or not? Like, does anyone want to give me a thumbs up or something? Or if you want me to start adding fees, I can. I don't mind.
Anish, it's too good to be true.
Yeah.
What do you mean there's no fees? There's no fees. I told you it was simple.
Yeah.
Yeah.
Yeah. So why is they're like, yeah, let's talk about that, right? It's too good to be true. How do you guys make money? Taryn, how do you make money?
How do I make money? We make money on the cash flow and properly investing the money for growth and appreciation.
Yep.
Yeah.
And so I kind of joke about, and you'll hear me, you've been watching these webinars. We don't want to trip over dollars to pick up pennies. That's what it comes down to, right? So most funds, if you look at it, it's usually a 2% management fee, right? And it's that, and what's going to happen, like for Taryn, Jason, myself, the 2%, even if it's 10 million, right? It's 200,000. I promise you, it's not going to change my life at all. Like, right? I mean, it really is not. We rather look at the asset class and be investors, and that's how come we even invested our own money to start the fund on that portion. But I'm cool with it if you guys you wanted me to add some fees and some chicken wing fees or all that kind of stuff. So it's just one of those things that it's unique. I don't know. I mean,
and I would say that the most important fee that we don't have is an early withdrawal fee. We don't have that.
No, we don't.
Yeah. And that's like
there's no,
for me, that's peace of mind, right? Like
no prepayment penalties.
Yeah. So even Eldon, yes, they do have CDs. Guess what? If you break your CD, there's fees, right? On your 2%. Can you imagine that? Like, you're only paying me 2%. Now you're going to charge me a fee too on that portion. So it is really important on that portion of the no fees.
Yeah. And David says, like, if you need to withdraw before a year, no fee. Correct. If you need to get our belief is that if you need to get your money out for whatever reason, we're going to do what we have to do to get you your money back as quickly as possible. Because once that life, whatever is happening to you is past, where do you think you're going to put your money back to? If we sit there and we're like, oh, well, no, you need to get your money out and we're going to charge you X, Y, and Z. Well, when you are ready to invest again, the likelihood of you bringing it back to us is not there. Right. So we're, it's a family. Like, at the end of the day, we understand things happen and, we don't want to penalize you for that. Now, if you got $10 million in the fund, it might take me a couple of days.
Yeah, exactly. And just so you guys know, this is not like an ATM, right? We need written notice. We will get it back to you in a timely manner, right? As soon as you do need your money, depending exactly what Taryn's saying, if it's millions of dollars, like we're going to have it deployed. So we might have to move things around to get you your cash. So we will need written notice on that portion that as soon as you need it, let us know, hey, you know what, I need it in January or whatever that is.
Especially now these times, we don't know what's going to happen in the market. Everybody speculates what's going to happen with the real estate market or the stock market, whatever the case may be. This is a great investment to actually just have your money earning on the sidelines and knowing that it's tangible, that you can access it quickly, gives a peace of mind, you know, and that was one of the motivations behind this, was that cash flow when you need it to use it, you know.
Yeah. And so what do you guys think the benefits are for a portfolio, let me spell that out, portfolio that is diversified, right? But yeah, but like, what do you think that, we kind of touched on them, right? What are, got to put in the chat. What are some of the benefits? And if you don't think there's any benefits, you should diversify in general, whether it's real estate, your anything on that portion, because right, the risk level is leveraged over a bunch of different asset classes, right, on that portion. If you're in the stock market, and you'll hear financial planners, the S&P 500, right, it's the top 500 companies, and you're in a fund, so you're diversifying your risk.
So I'll give you a little example of diversification, right? So if those of you don't know, I used to work in casinos for a very long period of time. And if you've ever been on like a cruise ship, it's a very small casino, or if you've ever been in a small casino, you'll notice that they don't have $100 blackjack table and then a couple of fives, right? And the reason for that is that the risk of a big table going up or down is too much to not have another one. So if you see $100 or $1,000 table, you're typically going to see 2 or 3 other of them, because the casino manages their risk and they can't have all of their eggs in one basket. Because if I go onto a blackjack table or a baccarat table and I go on a run, and all of a sudden I'm making $1 million or $2 million, I need my other tables to cover that loss so that I'm still making money, right? And so I like to bring it back. Gambling is definitely a great teacher when it's coming to investing. I think stocks are like the professional man's idea of gambling, because most people don't look at a P&L statement before they invest in a stock. It's just like, oh, this new thing came out and I'm just going to throw my $100 or $1,000 at this without having any idea of what the company is up to and what they're doing. So portfolio diversification, I see, like David said, ups will cancel out the downs, that's basically it, right? The idea is that there's different ways of diversifying. You can be diversifying in where you have some money in stocks, some money in real estate, because maybe stocks are down and real estate's up, which has been what's happened in the last year, right? But there's also diversification inside the asset class. So like if you're in stocks, maybe you have mutual funds and ETFs and so forth. In real estate, you don't want to just be in one asset class. You want to have single family, possibly. Maybe you're doing rentals. Maybe you're doing, like for us, we do single tenant commercial buildings, because the cash flow for that's really, really great. So you don't want to invest in a fund, and that's one of the reasons I didn't like syndications, because typically you're on one asset, or maybe 3 assets, but it's not normally more than that. At the end of the day, those assets, if multifamily take a hit, or COVID happens and rentals aren't getting paid, well, now your money's in trouble. Where if it's split up in a fund in different assets inside of that, like inside of real estate, you're mitigating your risk across the portfolio. So while one asset's, I'll give you another example. Like we have properties in Puerto Rico, right? So it's right next to where the cruise ship dock. And so, like if you've ever been to Old San Juan, the Diamonds International is one of our places. And, the corporate guarantees. Well, cruise ships stopped going for what, like 18 months? I think they've started going again. Yep. We didn't miss a payment, but there was no income coming in, right? Why did we not miss a payment? Because we had really great relations. We had corporate guarantees, so they had to pay us anyway. The ones that we didn't, and we had rehabs going in San Francisco. We had turnkey rentals in Ohio, which we've since gotten rid of. We've had commercial single tenant real estate. So regardless of what was happening in Puerto Rico, our assets in other areas kept our fund growing and being successful.
Yep. And like, one of our other tenants is Coach, right? So indirectly, obviously there's coach stores around the world, right? So same thing, same diversification, meaning no one was buying at that store, it didn't matter.
And I have to keep telling Anisha's wife that just because she buys a lot of Coach purses, it doesn't actually help us in the fund.
Yeah, that's of course she doesn't listen, but that's another whole story. That's another webinar.
I like to use the terminology recession proof. The fund's recession proof. Nothing's going to change with the inflation or anything else. You're going to get your fixed rate. The rate's going to be fixed over the course of the 12 months of the investment.
Yeah. And so, like one of the things, right? If you want to invest, right? And we use this quote all the time, like investment shouldn't be so risky and complex, right? And that's, sometimes you work so hard. I know some of you guys have JOBs, right? You bust your chops. I almost said something bad, but at work, and then you come home and you got kids, right? You hear Tara and Jason talk about kids. And so when are you going to work on your stuff? And if it's too complicated or risky, you're going to wind up doing nothing. And that's one of the challenges that you're going to have. And before you know it, it's going to be a year or 2 years. And this is with anything, right? It's not only in investing, it could be if you want to become a real estate investor or whatever your passion project. And before you know it, 1 year turns into 2, that turns into 5, and then 10, and I'm too tired, I'm too old. And one day you're going to wake up retired and you're going to be like, oh crap, what happened to my life? And I'm not where I want to be financially. And so what we try to do with the fund is to make it easy. And so some of the benefits of our fund, right? We've kind of hit on some of these, is it's low risk. Again, you cannot guarantee returns, but it's low risk. We got liquidity. So what we're asking for is a minimum 12 months on your investment. If you want to keep rolling it over, you can on that portion. The fund, it works, it's a little unique. You get paid twice a year, the end of February and at the end of August. And if you guys are on fixed income and you want to check, that goes right back to whatever asset class that you're using, whether it's your retirement, your cash, you could use those, you'll get a check right back into those accounts. Or you could do what I do, I just reinvest, right? I like that phrase of compound interest. Again, we mentioned no fees, unless you want me to start charging fees. I'm cool with that. No, of course not. Fixed rate, right? Like we basically, depending on how much you put in, it's anywhere from 6 to 8%, depending on the amount of money that you're doing. The 12-month minimum, as we touched. And more importantly, it's collateralized by real estate, right? And we're talking about, office buildings or commercial properties in Old San Juan, right? Some are mixed use, where we're doing Airbnb or apartments above, and downstairs it's retail. The high-end rehabs that we are doing in the fund in San Francisco, we're picking specific areas where Silicon Valley, where these executives, their kids go to school on that portion. And it's kind of unique, which always kind of like, it's hard for me to grasp, because, the real estate investor I'm always looking for a discount. The interesting thing is we could actually pay market price, right? And you're probably saying like, hey, you're paying market price, how are you making any money? We're actually adding value or building onto the houses. And we're generally building up on that portion. And to give you an idea, it usually takes 18 to 24 months a project. We're doing high-end rehabs where it's about $500 a square foot to build, but on the outlay, we're getting $2,000 a square foot. So we're creating money into the deals on that portion. So we constantly have cash coming in and out versus, other funds out there on what they're doing. I don't know if you guys want to add anything. I do see some, why don't we hit some questions too? Because I do see a bunch of questions. Let me open those up. So David's asking, does it really make a difference if we use IRA money or straight up cash? And the answer is no, right? So you could use, if you have a Roth IRA, a traditional IRA, a solo 401k IRA, literally you could use any kind of Retirement, you could use HSA accounts, but here's the big key. It has to be self-directed, right? So if your money's at, Charles Schwab or any of these other things, they have you limited on what you can invest, right? So they won't tell you that you can't invest in real estate or you can't lend. So a self-directed IRA, actually, if you're a member, Equity Trust is one of our members through National RIA. They actually waive about $720 worth of fees. So if you're a member and you want to move stuff to your IRA, that's a whole different conversation. And I could always help you with that too. Did anyone, Taryn, do you want, I think you want
Yeah, I was going to say about, like the question of, does it matter between using my cash and self-directed IRA? I would say that the biggest reason I would choose a self-directed IRA over cash if I had the choice. So in other words, I've got money sitting in both and I'm trying to decide which one I'm going to invest in the fund with. I would choose the self-directed IRA because at the end of the day, it's tax-free or it's tax deferred, right? If you're using your own cash, any income that you're going to get back is going to be taxed. So that, when you're talking about inflation, economic downturn, the two things that's going to affect your investments more than anything else is inflation and tax. And so it's always important to try to push the inflation off onto other people if you can. And the second thing is to avoid or structure your portfolio correctly to minimize your tax implication down the road.
Yeah, and to add to that, right, the other way to avoid inflation is, obviously buying real estate. The issue is, right, if you only have a certain amount of money, like I only have $50,000, and maybe it's in your retirement account, how are you going to get the money for the other part of it? Meaning there's a lot of lenders that won't do non-recourse loans. So you can't leverage it, right? So now you have the 50 grand in your retirement or whatever vehicle. What are you going to do with it? And that's a good way to leverage and hedge yourself against inflation. Maybe it's not the full amount, but it's better than what's happening right now.
You can also partner up with a friend or a family member, whoever, and you can actually, you don't have to be by yourself investing into the fund. You can actually have partners into the fund as well under one umbrella to accumulate more interest if you wanted to.
So, yeah, and I'm going to kind of just also touch on, so our minimum investment, I know we didn't really talk about it, is $25,000. And again, you could, like what I did was I used some of my Roth IRA, I had some cash. I used like 3 different income sources to get to the next level. And anything from 25,000 to 250, we pay 6% twice a year, end of February, end of August, no fees. 1 year minimum, 1 year minimum commitment. With commitment. I'm like, man, I'm getting old, and I can't remember everything. And if you want to hit the next level, anything over 250,000, we pay 8%. And again, no cost, so it's really 8% on that. So, and I know Raphael, you're asking any tax incentive. Well, it depends on what kind of vehicle you're using. Right. So if it's either, if you're using retirement accounts, if it's tax deferred, then it's gonna be tax deferred, right? It's gonna go right back into your retirement account. If it's a Roth, right, it's already post-tax dollars. So the money is actually tax-free on that portion because you've already paid it.
So let's talk about one of my favorite investing strategies and how the fund can work with it. So how many, and you're going to have to post in the chat now because I need to make sure everybody's still with us. How many of you know what an arbitrage is as it pertains to investing? So I'm going to give you a couple of seconds. So I got one yes. And if you don't, it's okay because I'm going to explain it using other people's money. All right. Nope. All right. Okay. So an arbitrage is where it, Eldon's correct, using other people's money. So you're using leverage in one area and you're investing it. So one of the ways you can do this, and I know Anish does it, is by using life insurance policies, right? So if you structure it correctly, and this isn't a webinar on life insurance, so I'm not going to go down this deep dive. However, if you choose the right investment vehicle in life insurance, you are able to leverage the life insurance while it's still making your dividends and making your returns. And the fact that you can leverage your life insurance. So let's say, I know Anisha's got, I think what was like 3.7, 3.9% you were able to get on your leverage.
Yep.
So let's say he's got $100,000 loan on his life insurance at, call it 4%. He's able to take that 100,000 and put it into the fund, and he's going to make the arbitrage on the other 4%. So he's making 8% in the fund. He pays the 4% back to his life insurance, and he's created a 4% yield on money that's not even his.
Yep. And just so you know, like it's, again, that's the 8% and it's 250, right? So in real terms, like I made an extra $10,000 just moving money a year.
Just moving money.
Yeah.
And so like, there's a lot of different ways you can do that. You've got to make sure that anything that you do is risk averse, right? So I take that with a pinch of salt, because I'm going to talk about HELOCs right now. You could actually take a HELOC and take that money and invest in the fund, because the fund is a 12-month minimum commitment. It allows you, like, if there's any movement in the market, if something changes, you can get it back out. Where if you were going to take that HELOC money and throw it in a syndication, and if anything moved, you might be in trouble with your own personal residence, right? So you could do something like that. I don't really recommend using HELOCs, because I don't like over leveraging assets, especially not your primary residence. I do love life insurance policies that you can leverage against. Some people have stock accounts that, like ETFs and stuff like that you've created in certain companies do this, where you can actually leverage the stock account, and you can take that leverage and invest in the fund and create that arbitrage. And so really, like, true wealth is about moving your money in such a way that you're capital and yield stacking to make bigger returns on other people's money. So, I mean, that's a kind of an advanced strategy for people, but I love to bring it up, because when you start to get to play in that area, this type of fund it makes that a huge win, and it makes it kind of a no-brainer, because you have that liquidity, you have a fixed rate, it's not going up and down on you.
Yep. And
go ahead.
I'm just going to add, so you're going to, now, because you just said that, you're going to make me put my disclaimer in, right? We are not financial planners, right? And we're not giving you guys investment advice. And Kevin's right. He just put in the chat, because of what happened today and the market and some of the things that are going on, there's a lot of margin calls. So if you are using stocks to leverage, if you don't have, like, the easiest way I could tell you is you must have, or you should have, multiple exit strategies in whatever you're investing. Yeah. And if you don't, right, don't do it. Like, that's what I'm going to be really easy about it, because that's what happened in 2000. I didn't. I thought I did. I was the easiest way, I was drinking the Kool-Aid, right? Everyone else is doing this, and I was following. So you have to know where you're at. The other thing I'm going to add also is whether it's an accountant or financial planners or life insurance, they're not all created equal. The people that are selling these products on that portion. So you're going to have to bet them. I'm not saying you're going to become an expert on any of these things, but you have to know some of the basics and the right questions to ask, right? And if you've been following the webinars or if you actually met me, I'm 100% transparent. I'm telling you what I did, about my bankruptcy, all the stuff that I've done. So if they're not as transparent with you, maybe that's not the right people that you want to work with in general. So, but again, we're not offering investment advice. I'm not saying to go, pledge your stock accounts or any entire, none of us are saying that. So as long as, but it's possible, right? So my risk averse, I'm betting on myself on the fund. And for me, personally, last year, I made an extra 22% on my portfolio, just moving things around. But I live and breathe this. I'm a different end of what a lot of you guys might be. But again, I have proof of concept of what I've been doing personally.
Yeah. And one of the things I strongly believe in, and I know Anish and Jason do as well, right? In any investment, and I don't care what it is, you mitigate the risk as much as possible, and you let the upside take care of itself. Because I don't know about you, but when I look at investing in something, the very first thing that I care about is, how am I getting my money back? So if I'm putting, $100,000 into something, I only care about getting the $100,000 back. That's my first concern. And then let's talk about what I'm getting on top of that, with a return on my investment. Right.
Yeah.
So those of you that were talking about interest rates of, 6-10% and things like that, that's great. But I guarantee if you look at it, it's probably, I want my money back first, as long as I don't lose money. And I know Anish is definitely like that. What was that stock that you had bought that you had lost money on?
Really?
And he was, it was
Well,
sometime last year. He was like, I'm finally in the green on that stock. Do you still have that stock, by the way?
No.
You got rid of it?
You're gonna make me cry. Like, really? Hit me under the belt. Yeah, it stunk. It's an understatement.
Taryn, I think you hit the hammer on the nail. I mean, that's the biggest thing here is the exit strategy and knowing that your money is, your liquidity is 12 months and it's easy to, it's tangible.
Yeah. I mean, we're like, I want people to know, like, right, you're not like, I kind of joke about it. Safe and easy is boring. I need my life on my finances to be boring. Like, that's the easiest way I could say. Like, like, I like the rush, like, oh yeah, if you bought Tesla stock, 10 years ago or 12, you're like, yeah, I've done this and this. And it's the same stuff in real estate for what I see is the amount of investors that I see that make money. You only always hear about the good stories, right? So on the real estate investing at the RIA, Jason, we've kind of chatted about this, is like, I probably get 3 to 5 calls a month of people losing money on deals on real estate, right? No one goes to their friend and says, oh yeah, I bought this house and I lost 30,000, right? I'd love to have, the bigger pockets. Like, yeah, I bought 6 places and I lost money on all of them. Right.
I actually had a lady talk to me, and I think you were in the conversation. She was like, she had done 3 or 4 flips and she had lost money on every single one of them. And she was like, yeah, I consider it the same thing as if I got a mentor. I was like, well, if you had just gotten the mentor at $30,000, you would have made money on all 4 of those things. Like, it just didn't make any sense to me.
And it was actually more than that. She lost 4 and she kept going. And then it was like almost like 8 or 9. And then she was like, okay, now like she finally made money. So kind of made me laugh about that too. Like, what the heck? And so I got a question here. Can I invest DPI from my 401k account? The answer is yes, but it has to be moved to a self-directed. So what I would tell you, if you're working and you have a 401k, again, I'm not financial advisor on that end of it. It's great if they're matching. So I know some of the employers are not matching, or they're only doing a certain amount. So if they're matching, what I would tell you, again, this is my own opinion. Yeah, that's free money. Like, I'm all for that. But if they're not matching the other half of it or not, and you want to move it, you can move some of it into a self-directed and then invest in a fund.
Yeah. So with the 401k, if it's an employee one, sometimes they won't let you move it out until you've terminated employment. So that comes into it. I know for myself, when I was working at the casino, I had a 401k. They did match like 15%. So it was really great. And I waited to things like, so when you're pulling money out of a 401 to avoid the penalty, it's got to be a financial risk, or you're buying a property. And I forget what the third one is. There's only 3 ways. And, but during hurricanes or like natural disaster events, they allowed you to pull out money with no penalties. And so what I would do is I would pull it out at that point and move it into other investment opportunities where I could make more money. Because for me, I look at it this way. I don't really want to grow a 401k and then have to pay taxes on the back end on a big amount. I would rather take my hits now. And this is just, again, not financial. It's just what I prefer for myself. I'd rather take my hits now and grow it tax-free so that I don't have to worry about it later on down in life. It's definitely one of the things that I did was I pulled all of my money out of my 401k, and that's how I got started in investing with real estate. And I mean, my returns are like infinite at this point. But disclaimer, I don't say to do that. Any of these things, any of these strategies that I've spoken about, again, it's just a possibility. I wouldn't take a HELOC on my property, invest and do the arbitrage. I wouldn't do that. It would be too much risk for me. I have a property up in Virginia Beach. I've got a loan to value of 55 because I won't refinance it, because I just don't like where the numbers are if I refinance it. So I'm a very risk adverse when it comes to things like that. But the idea is that there's a lot of ways to move your money. There's a lot of ways to invest through that are tax-free. I don't know them all. And so it's important to us to kind of like, tell you what's possible out there, because maybe you come up with something that's even better and you tell us about it.
Yeah, absolutely. And I think that's just really important. And I put a quick poll up there, accreditation. So you're saying what and some of you guys are unsure if you are accredited. So that's one of the things is our fund and our sister fund, we take accredited investors and non-accredited also. So to give you guys want to explain, Taryn, or what an accredited
Yeah,
is?
so an accredited investor, there's a couple of ways that you can be accredited. One is, I believe, you have $1 million in your own personal property,
Absolutely, not
asset,
excluding your house. Yeah,
excluding your house.
your
Um,
homestead property. So
and then it's 250,000 that you're making per year, and if you're married, I believe it's 350,000.
correct.
Are there
So
criterias?
correct. So and the way to find out you're accredited, like we'll either need bank statements or a letter from your CPA that you're accredited. And what it really means, right? The SEC, what they want is people to know, like people that understand money. So they're saying if they have a certain amount of assets or income level, they can make these decisions. And it keeps, I hate to say it, like unfortunately there's a lot of unethical people asking for money. It's to help protect, to an extent, investors out there, right? So I mean, that's one of the reasons they're asking for accredited. We do have a sister fund that's for non-accredited also, so that's something that's important too.
Yeah, and I believe that they add a qualification for accredited is if you have the level of experience and knowledge
Absolutely.
as well.
Yeah, if you're in certain fields also, they'll let you be accredited into the fund. And for us, if you're actually interested in investing in our fund, we send our team, our COO, Ashley will send you a short questionnaire to fill this out as an initial portion, and then we'll take it from there on the next step to invest. One of the other cool things is the day you wire your money, your interest starts that day. So I think that's as soon as it hits our account, guess what? That's when day one of interest starts. One of the things that what we have like planned for the fund is down the road, as we start really accumulating, funds and start really building our portfolio for the fund, like we are going to be looking at different asset classes, right? And we're going to do value add like a syndication, and we're going to go back to our original or our original investors and say, hey, do you want to be in a project, or are you happy with that?
So Anish, let's talk about a fund of funds quickly, because we mentioned it, but we didn't really say what it is, right? And so when we were talking, it was beginning of COVID, and we were deciding what type of fund we wanted to put together and what we were up to. And we talked about some of the benefits earlier about having the money ready to go into an investment. That's one of the biggest challenges. Like, you've got a deal, and now I've got to make all the phone calls and be like, hey, are you interested in being in this deal? And so there's a stress amount trying to raise the fund on the timeline. Or the other thing is I have a conversation with you and you're like, Taryn, I have $250,000 ready to go. And then 30 days later, I find the deal and I call you back up and you're like, oh, sorry, I put it in this other opportunity, right? So what a fund of fund is that we are able to raise money into SFI, which is Sharif Medawar's fund. We are a co-sponsor of it. So when your money comes in, it's going into either SFI or MIGSIF, right? And they have a proven track record. MIGSIF was created in 2009, SFI 2015, and you're backing on $100 million worth of assets, right? A real estate portfolio, and you're making your money directly the minute it goes in. DPI is our fund. So somebody asked, who the primaries are. It's Jason, Anish, and myself. And so with DPI, eventually we're going to be at the same level as SFI with a huge portfolio. But in the beginning, we're going to be acquiring assets one-on-one. So remember we said, and when you're choosing like a syndication and you're going into one asset, there's more risk, right? You have to make sure we've chosen the right asset. Are the returns there? So what we're going to do is we go back to the investors that have invested with us, and we say, hey, listen, we've got this project, and being a fund of funds, you can move your money over into DPI. And because you've already trusted us and you're now on this one asset, we're going to give you an increased, it might be an increased interest, or it could be an equity share, depending how we structure the deal. And so, some of the things that we're going to be looking at are like self-storage. We might do an assisted living. Jason loves those, as you can tell.
Dude, I still do. Don't get me wrong. I still love those. I think it's a great business, great in real estate and business.
Yeah, so we chose this model because it really hit everything for everyone. It's a safer, secure investment for our investors. You get paid straight away, right? And listen, like, you might turn around and say to us, no, I'm good. I want to just stay where I'm at. I'm not interested in investing in this one asset. And that's fine with us.
Yep.
Right. But you're now able to say, you know what, maybe you've got $500,000 in and you're like, okay, you know what, I'm going to keep 250 on this one, and I'm going to bring the other 250 onto this deal so I can make a little bit better. So now you're diversifying that way. It just we felt that it had a lot of benefits and it had a lot of flexibility, and it kind of hit all of the, as Jason was saying earlier, all the positive points from the other funds without as many negatives.
Yep. And the other thing is, like, the way I look at it is, you're betting on, like, to be honest, the team, right? Who's actually running the fund, any fund. And, for me personally, like, I've been in real estate for 20 plus years. I've done well over $250 million in real estate transactions, from lending, selling, wholesaling, rehabbing. It's probably a lot more now than that number, but, it's a ton of experience. I know a lot of you guys are local, right? I've seen you guys at some meetings. I've seen you at some of our events. Most of you guys know I live in downtown Fort Lauderdale. I'm not going anywhere. You have access to my cell phone, so we're not, some group out of town or any of that kind of stuff too. So it's just one of those things that will you become rich investing in our fund? Maybe, it's, as I said, it's not like, hey, it's not like the crypto rush of, like, hey, I'm gonna put some money in tomorrow, I'm gonna be this. But the risk level is also very different, right? Like I told you, as you get older, or at least for me personally, is I want when it comes to my money, I want it to be nice and boring.
Yeah, I would say it's like slow growth with the opportunity of bigger investments. And Julio asked, whether the money you invest is attached to a specific asset or the entire portfolio. It's attached to the entire portfolio. And so, like, $100 million portfolio, you're going to get a note against the entire thing. So that's how your money is going to go in when it's invested. Later on down the road, as we start to acquire properties into DPI, then we're going to come back to you, Julio, and say, hey, listen, we've got the self-storage unit in Northeast. This is what it looks like, and this is what we're offering. Do you have any interest? And then you get to choose at that point. Yeah, you know what? I do want to jump into that project, or no, I'm good, and I'm going to stay on the entire portfolio. It just depends where you are financially, whether you're looking for that stable, I know we have one investor in the fund right now. He just reinvested and he doesn't even think about it. He likes that, right? And he has more risky investments that he does outside of us. So I hope that answered that question.
Yeah. And it's a good point on that. Again, where it's over the whole portfolio. We talked about there's cash influx. To give you an idea, the buildings in Puerto Rico generate, I know someone's talking about 10%. They actually generate 18 to 24%, depending on the building. So, and that's because also the tax situation in Puerto Rico, which is a whole nother conversation, where it's more money in your pocket. And so that's how we're able to pay these rates or dividends or on these investments. There's enough of a spread in there, besides also the money coming in and out on the chunks of money on the rehabs out in California too.
Yeah. I for those of you, you mentioned the tax thing. For those of you who don't know, some of you might, there's a thing called Article 21 in Puerto Rico, which allows them to pay a significantly reduced tax rate. So for instance, if you were in California and you had a business in a fund, you might be paying, upwards of 40%. I think some people have said 50%. Puerto Rico, they pay 4%. So it allows us to be able to invest in these different projects and things like that. And we can put more money into our investors' hands. Right now, Anyway, let's go on to the slide.
Yeah. Yeah. So, I mean, again, to be part of our fund, our minimum investment is $25,000. You could use different, vehicles to get to the 250,000. As I did, you might have 100 in your retirement. You might be sitting on some cash. What we didn't even talk about, and I'll just kind of mention it real quick also, with our fund, there's a chance of, if some of you guys are doing a 1031 exchange, we could step in, and there's a way, I don't want to say it's around it, because you always have the government always needs their taxes, but there's a way that you're not just keep reinvesting into more properties or larger properties, because what we were finding is people saying, hey, I got a great price on my property, but what am I going to invest in it? So there are some advanced things that
so
you can do with the fund.
it's a sales installment where you can roll your capital gains into the fund. And that's a great way. So this way you don't have to roll it into something else on a 1031. And that gives you a lot of time and earnings. But obviously when you do pull the money out, you will have to pay Uncle Sam. When you do pull, you're earning money as far as interest, that's your income. And then you'll be earned when you do pull your capital gains at some point, whenever you pull it out of the fund, yet you do get hit on the taxes eventually.
Yeah, and usually, just so you guys know, that if you're in that situation, give us a call and we'll kind of walk you through it. And because it's super specialized on what your situation may be. So we'll explain in detail how that really works too. So as we mentioned, accredited or non-accredited. So if you don't hit any of those parameters, it goes into our sister fund, MIGSIF, and there's a way about that. And we'll talk to you on the one-on-one. They're fixed rates, right? 6% or 8%, depending on how much money you put in. You get paid twice a year, end of February, end of August, no fees, right? And you get interest from day one. And again, we're looking for a minimum commitment, and now I don't remember the word, commitment of 12 months on this investment. If you look at other companies out there, as we mentioned, syndications, you're usually looking at minimum 3 to 5 years. And again, there's nothing wrong with these other vehicles. It's just that if you're trying to figure out what to do with your money versus it's sitting in your bank account, and what you'll realize is a year goes by quick, right? Before you know it, it's already 6 months, 8 months, it hasn't done anything. And then you're stressing out like I was, right? And then you're going to start making bad decisions on trying to make up that money. So I think that's always important too.
Yeah, and I would say, like, when we send out the checks end of February, end of August, we also send out a letter letting you know what we're doing, what assets we've sold. So you have an idea of what's going on, and you're part of the investment. It's fun. I don't know. I like it.
Yeah. So today again, and I thank you guys for hanging in there today. And I know we're a little bit over time, but we wanted to give you an idea of what the fund really does, what we're part of it. As I said, that, a lot of you guys have been supporting our RIA in general, which I always totally appreciate. And we're constantly trying to build growth. I mean, that's what I'm committed to by having this RIA, is to really build revenue, growth, and all the things you want in your life, whether it's, real estate, life insurance, and a lot of these things I had no idea before I became one of the owners of the RIA. And I got to meet, I get to meet a lot of people that are way smarter than I am. And I just do what they say. And that's why we're really excited on, this fund. What you can do, if you look on your screen, you could go to our website, you could book a discovery call. It'll be one of the three of us. You could grill us, tell us what your situation is, and we could take it from there too. So any last words, Jason, Taryn?
Well, Julio had a quick question.
Yeah.
So he says, if you use your Roth IRA, there's no taxes, correct?
Correct, right? It's going to go right back into your Roth. So
or you can roll it right back into the fund so that it's increasing.
Correct. Yeah. So there's no, and again, I'm not an accountant, but yes, Roth, remember, it's post-tax dollars. You've already paid the tax on that money. And that's in any investment, right? If you're lending, you're buying properties, you already got hit once, so you're not going to get hit again.
Yeah, so you can definitely go to the dpifund.com, check out a little bit more, book a discovery call. You can see some testimonials on there from investors that have already been, investing in the fund since its conception. This is it's a simple way to invest. We're not asking you to, clear out your life savings and put it in one place, right? Give us a chance. It's a great place to put a little bit of money, diversify your portfolio, and you're going to find 6 months time from now, it's probably one of the simplest investments that you have. And then you get to go to your Thanksgiving dinner and be like, hey, I'm invested in these properties in Old San Juan, as you are.
Yeah, exactly. I mean, and I know some of you guys, you might have family or friends that are working, and they could obviously see the replay on this webinar, or they could just give us a call. As we mentioned, with the fund, we put our own money to start the fund. So we're investors ourselves, and we believe in the product that much too. So Jason, any last words you got for?
No, I think we covered everything. I think we give it you guys did great. I mean, Anish and Taryn are our mentors at BPM. They do fantastic. You guys spoke great today.
Yeah, well, what Jason's really saying is that how the heck do I get my words in between Taryn and Anish? Always, say so much on that portion. So, they're always a handful is probably an understatement. You get Taryn and I in a room or on a webinar, this could turn into like a 9-hour webinar about
definitely. Jason hasn't learned how to interrupt us yet.
I actually, I learned from you guys too. So don't get me wrong. I like to listen and learn, because when you learn, you earn. And I'm always learning from you guys and growing and making money. So that's why I enjoy our partnership.
Yeah, and I just saw one of these questions that just popped up. So as Taryn was talking about the fund of funds, so that's been around since 2009. So the payouts have been going around since 2009. Our DPI fund itself has only been open for a little less than 2 years. So there is a little distinction on that. So Alexa, any last announcements or?
Of course I do. So everyone, any follow-up questions, go straight to dpifund.com. You can request a conversation right from the website. You won't be requesting a booking time, but you will be able to submit your contact information, and you will be reached out by one of the amazing people on this webinar today, so that you can get any follow-up questions and all the information that you're looking for when it comes to DPI Fund. So that's just something I just wanted to tell you guys, in case you're wondering, like, oh, what time are they going to call me? They will reach out to you. So look out for that. One last thing is I will see you guys all next week at our webinar, but I do want to say happy Veterans Day to all of our veterans tomorrow and every day. Thank a veteran anytime you can. I'm not one, so I can't relate to that, but you guys know what to do. And we will see you guys next week.
Actually, you know what I'm going to do also, if there are any veterans on this webinar and you want to get a membership with BPM, let's just take $100 off. So if you're a veteran, and that's a small thank you from us at BPM, I'd gladly take $100 off of your membership or your renewal or anything out there. That's the least I could do for all the hard work and things that you do. So we're easy here. So
yay, thank you so much, Anish. We will send you guys all an email about that tomorrow. But of course, all of you in here will get a follow-up email from me with all of my contact information in case you have any questions. And I will definitely include DPI Fund's information in there as well. So
absolutely. And I know some of you guys said you guys are ready to, to invest. So if you don't even book a discovery call, maybe I'll just reach out to you and see what questions you might have out there too. So don't be surprised if you get a quick email or call from me too. So thank you guys. Have a great weekend. Thank God Hurricane Nicole missed us. So we've been lucky already so far, and we look forward to it. And we'll see you Tuesday for our next webinar. Make sure you give us a 5-star Google review because it's important to me. Otherwise, I'm going to find you, chase after you. I know where you live. No, I'm kidding. So
It's not scary. You're not scary.
the old threat. So awesome. And we'll see you soon.
Yep. See you
Sure.
guys
Everybody.
Thursday.
Bye-bye.
Take care.